Hey guys, I wanted to do a quick video about the topic of diversification. Now, I already did a video about asset classes, and a lot of that was an introduction into diversification too. Basically, what asset classes are buckets for you to diversify your portfolio. So when we're talking about diversification, I like to use the example that we often have heard of in science. So I'm sure you all taken a biology class. One of the stories that they use is they talk about an ecosystem, right? And they talk about how a diverse ecosystem is much more stable than an ecosystem that only has a few sorts of species of plants and animals, right? And the classic example is, say a disease comes into an ecosystem and there's only one type of plant that's susceptible to that disease. Well, that plant is going to be completely killed and the ecosystem will die. But if you have an ecosystem with hundreds or thousands of different plants and animals, maybe a couple of those animals are susceptible to that disease, but not all of them. So you have a healthier ecosystem. So that just means that when something comes along and messes with the ecosystem, it's not going to destroy it completely. And so we use that same principle when we're talking about our portfolio. So when you're investing in asset classes, you want to make sure that you're diversified across multiple different asset classes. And the reason you do that is just because you don't want to put all your eggs in one basket. Additionally, you're just never going to be sure what's going to perform the best in any given year. You won't be able to pick a stock that you know is going to do well. People have tried, and it's always shown that actually even the best investment managers can't do it. So the saying that's used is, instead of trying to find the needle in the haystack, why don't you just buy the haystack? And that's why I've recommended sort of buying into these passively managed index funds, which give you exposure to lots of different stocks. But on top of buying into index funds themselves with lots of stocks, you also want to diversify across asset classes. And again, I'll put a link in the description to the video that I did on asset classes. But we know in that video, we talked about how there are certain asset classes that you can invest in. And the broad ones are US equities, international developed equities, emerging market equities, inflation hedges, which are commodities and energy, deflation hedges, which are bonds. And so those are sort of broad buckets of what you can invest in. So after this video, you're just gonna learn sort of some broad diversification tactics, why you should diversify, what you should diversify into, and what you should do when your sort of diversification mix changes over time. So first off, I want to show you this really cool graph that I use and that a lot of people use. This one happens to be done by BlackRock, which is an investment management company. And what it illustrates really is just that we're never sure what's going to be the best investment in any given year. It's just the reason why you should diversify, right? So if we look at this chart, we can see the annual returns for each of these asset classes. And you don't need to be familiar with all of these asset classes. You just have to know that they invest in different types of stocks and bonds. I'll put a link to this chart in the description, but all you really have to know is that any given asset class will perform at varying levels over the years. And you'll never be sure where. So if you highlight any of them, you'll just see that sometimes the asset class does really, really well in a given year and doesn't do well in another year. And so the goal of your portfolio is just to diversify that risk. So if you have really strong gains in one year, you can then reallocate that money into an underperforming asset class the next year, and likely it won't do as well because there's just fluctuations in sort of how well any given asset class does. So this BlackRock chart really just shows you year by year how asset classes have performed. And you can see that, let's take for instance, US equities, right? In certain years, it's one of the top performers, and in certain years, it's actually very low. There was a year where it returned almost minus 20%. And in that year, you wouldn't have wanted to be invested completely in US equities because you would have lost a lot of money. So by having multiple asset classes in your portfolio, you're just making sure that your risk is spread across many asset classes. So diversification just really helps us avoid unwanted risk. On the whole, I'm going to go through another chart right now. This is from Vanguard, and this shows a similar year by year annual return, but it separates out equities and fixed income. And on the whole, you're going to end up with higher returns year by year over time with equities, but that comes with more volatility. So the equities will have higher highs and lower lows. But you can see that even within equities, different types of asset classes perform differently. So the way they split this up is into small cap stocks, large cap stocks, emerging market stocks, and then developed international stocks. And you can see that every year, the order of what does better changes. So the key is to have exposure to all of these so that over time, you have multiple asset classes that are working for you. In the same way that there are different types of equities, there are different types of fixed income. And in this chart, we see that there's high yield fixed income, real estate, US fixed income, and global ex-US fixed income, which is just international income. And so you can see that there's a huge change of like what is the highest performing fixed income in any given year. Again, the thing to note with fixed income is that there will be lower highs and higher lows. So the volatility will be less, but your returns will be also less. And these charts just help to illustrate that you can never predict what's going to do the best in any given year. So having exposure to all of those is really important, just so that your portfolio has diversified risk and diversified reward. Okay, so Vanguard has published like a really good overview of why diversification is good for your portfolio. And I'm going to put a link to this article in the description. But one of the important things to know about diversification is that you can diversify in many different ways. So Vanguard, in this article, they outline a few different ways that you can diversify. One of them is market capitalization. So this is when you look at different stocks with different market cap sizes. So we can talk about a very large cap stock as something like Microsoft or Apple. These are huge market cap stocks. Mid cap stocks generally are companies that have a market cap between $2 and $10 billion. Now, it sounds like a lot, but relative to large cap stocks, this is like a sort of like the middle. And so when you're thinking about market capitalization, your large cap stocks will generally grow less, whereas there'll be lower volatility, and small cap stocks will have the opportunity to grow more but have higher volatility. Another way to diversify your portfolio is by sector. So Vanguard actually offers a lot of sector ETFs, which are a nice way to get access to different sectors of the economy. They outline sort of technology, healthcare, energy, financials, but there are consumer staples, consumer discretionary. There's lots of different sectors that we can invest in. And you may, for whatever reason, want to allocate more money into one sector than another sector. For instance, like financials may have not done very well in the past few years, and you may want to increase your exposure to financials by buying an ETF that invests in financial companies. The next way you can diversify is through geographic region. And once again, Vanguard offers ETFs that give you exposure to different countries and different places. So that just means that you can invest in the US market. They have a ton of US ETFs, but you also want to invest in countries outside of the US. And we talked about this during the asset allocation video, that you want exposure to different parts of the world because economies fluctuate in different ways. Certain economies carry political risk, and some economies do better because they sort of work in certain sectors of the market. So it's good, again, to have exposure to these different countries so that you spread your risk across the world. And finally, they mention diversification across investment styles. And specifically, this is between growth and value stocks. I'll do a more in-depth video about growth and value stocks, but generally growth stocks are what they sound like. They're stocks that will tend to grow a lot. These will tend to be newer companies, companies that are smaller in capitalization, any company that likely hasn't reached a steady state. Whereas value stocks are blue chip stocks. They tend to be very large cap stocks that hold their value, but are less likely to grow over time. Now, one thing that we want to talk about when it comes to diversification is a sort of principle that underlies it, and that is of correlation. So as you saw in the chart from BlackRock, you saw that certain asset classes do better in certain years. Now, this is a product of correlation, right? So correlation just means when one asset class moves up, how much does another class move up with that? And so what you want is to decrease the correlation that you have among asset classes. Because if the US stock market is 100% correlated to another asset class, that means that the asset class will move 100% with the US market. And what you really want is you want asset classes that aren't moving completely with each other, so that when the US market moves up, maybe your international market only moves up by 50%. Or if it moves down by 100%, your international market only moves down by 50%. And this will help protect your portfolio during down times, and it'll also give you the chance to rebalance your portfolio. So another key component of diversification is understanding what your risk tolerance is. Because what you want to make sure you're doing, as we talked about with asset allocation, is you want to determine how much you want to target for each of your asset classes. And really what is important about this is understanding your goals. So if you're very risk averse, you're going to want to place more emphasis on lower risk assets like bonds. But if your goal, when you're younger and you have time to withstand volatility, you're going to want to target riskier assets that have a higher return profile. So creating target allocations is really about understanding what your goals are and then sticking to those goals. And they can change over time. As you get older, you may want to bring down the risk of your portfolio. Again, I'm going to do a video on rebalancing later, but what diversification allows you to do by having access to many different asset classes and having a target portfolio composition, when different asset classes perform either better or worse, what you do is you rebalance back to your targets. Often rebalancing is called the only free lunch in investing. They say that because, it doesn't depend on factors outside of your control. It just recognizes the reality of investing, that different asset classes will perform better or worse in any given year. And so what it does is it just takes those outperforming assets and it reallocates the excess funds to underperforming assets so that you're back in line with your target allocations. So the last thing I want to talk about are the mistakes to avoid when it comes to diversification. So Vanguard outlines 3 different mistakes that people can make. The first one is that you diversify excessively. And so what they point out is that a lot of these ETFs will contain overlapping companies. And what you don't want to do is unwittingly gain added exposure to certain companies because you're buying multiple ETFs that contain those same holdings. So buying more funds doesn't necessarily equate to a better strategy. What you want to do is have a sufficient amount of diversification, but not so much that you're then re-exposing yourself to assets that you already have exposure to. Another mistake that Vanguard outlines is ignoring correlation. So again, what you want is to have different asset classes that don't move completely in tandem with each other. And so you might overbuy certain asset classes, assuming that it diversifies your risk. But really what ends up happening is you're getting the exact same exposure. Because if 2 assets move exactly in tandem, that's not really diversification. So what you want to make sure, again, is keep it simple. Buy a few different ETFs that give you a wide range of exposure, but you don't need to buy more than that. And the last thing that Vanguard emphasizes as a mistake is not rebalancing. So naturally, as we've stated, different asset classes will over or underperform compared to one another. But what you need to do on a regular basis, and Vanguard actually recommends not rebalancing too often, but maybe at most once a year, what you want to do is rebalance back to your targets. So again, a lot of investing is just staying consistent and disciplined. So you outline your target allocations, and naturally your portfolio will drift away just because of varying performances. But what you want to do is rebalance your portfolio so that your asset allocation will match your target allocation. And this is really just to make sure that your portfolio is in line with the risk reward profile that you want, because your asset allocation should reflect your long-term financial goals. So yeah, in this video, we talked about diversification by different asset classes and the ways that you can achieve diversification. And we also talked about some of the pitfalls of diversification. So the key to diversification is gaining broad exposure in a simple way. So again, you don't need to buy a lot of ETFs, but you should have exposure to various asset classes.